This could very well be a historic budget, one that sets the roadmap to simplify corporate taxation, eliminate exemptions and deductions, and reduce the corporate tax rate to 25%. But then, Finance Minister Arun Jaitly is also walking a fiscal tightrope, the promise to bring the fiscal deficit down to 3.5% in the face of global economic headwinds and additional expenditure on pump-priming the economy and paying higher government salaries as well as retirement benefits to the armed forces. So what will he do? To answer that, I have with me three tax experts, Nishith Desai, Dinesh, Kanabar and Pranav, Sayta. Gentlemen, to all three of you, a very warm welcome. I'd like to start by laying out what the macro looks like, because tax policy can't work in isolation. And the truth is, Mr. Kanabar, and I'm sure your clients will tell you that it is a very difficult business environment right now. And the Finance Minister is facing that as well. He has, like all of us know, a very difficult fiscal balancing job to do. How would you describe the current environment as we go into the budget?
So we have a fiscal budget projected at 3.9% this year. And if you look at our budgeted collections this year, we have about 6.5 lakh odd collection on account of indirect taxes, where the government is running 30% ahead of the budgeted collections, primarily on account of larger collections on account of oil revenues.
Correct.
And if you look at direct taxes, which is key to what we are talking today, we are 10% ahead of last year, but we still got to cover 40% of the budget. And 40% of the budget with just one installment of advance tax to go looks like a very tough thing. And as you mentioned, Menaka, I would agree with you that we have the 7th Pay Commission, we have the army payments out. So we have a number of things. And in fact, if you look at what has been happening over the last few days, virtually, there are interim dividends being announced by PSU.
Yes.
There are buyback schemes which are being announced. So obviously, collection and meeting the fiscal deficit is a key thing for the government. Therefore, I would agree with you that the Finance Minister has a very tightrope walk to do. But that said, probably one of the things which has emerged is that if one has to revive the investment climate in the country, simplification of tax laws is inevitable.
When you look at the projected targets that he puts in for the next year, the next fiscal in this budget, what do you think he ought to be estimating the tax growth to really be?
The one thing that he has to keep in mind is that now, with the inflation rate having come down, the nominal growth and the real growth, the difference that he was seeing is not significant. So in that sense, the nominal growth not being so large, the corporate tax collection growth also has taken a beating. So I do not think he is going to project a huge growth in the corporate tax collection in the current business environment and the or less inflationary or pricing power environment that we are seeing now. But yes, in terms of the meeting of the fiscal deficit, I certainly feel that he'll want to try and meet it as much as possible, especially given what Raghuram Rajan is saying. The big advantage that he has is because of the drop in crude prices, commodity prices, he's got a big uplift on the indirect tax side. So in this year at least, he's seen a big growth on the indirect tax collections, and that might very well continue into the next year if oil prices and crude prices are going to stay the way they are going to stay. I would feel that he has limited room when it comes to giving big fiscal sops, but to revive the business environment, I think even reducing uncertainty, bringing clarity, simplifying the tax regime, reducing litigation will be big sops in reviving the investment environment.
I think I have two points to mention at this point in time. First of all, room is very small, possibly, but heart should be large to get the things in place. What is not fair is not supposed to be in our laws. Okay, today laws are ambiguous, penalties are disproportionate to the offense committed, and citizen doesn't know exactly how to behave, and that deters a lot of productive.
But that's very sweeping,
okay,
no, Mr. Desai. Specifics to what the budget can deal with.
The time has come to reduce taxes and remove exemptions, no doubt about it.
Okay.
Barring some
So
exceptions.
I want to argue that. No, I
know.
want to put that one question to all three of you as you all jump into the debate, and that is, I think if you look at the government's own data, it says that of the 5,64,787 corporate returns that they saw in the year FY14, about little over 3 lakh companies reported any taxes paid because they reported profits. The rest were actually either not making profits or making losses. And the effective tax rate of the entire sample was 23.2%. Now, that's what corporate India is paying today, okay? The finance minister has said he would like to bring down over the next 3 to 4 years the corporate tax rate to 25% from the current sticker price of about 33-34% and do away with all exemptions and deductions. Will corporate India want an effective tax rate to go up from 23% to 24% or 25% if it means lesser jhanjat with all the deductions, eliminations? And is this the right economic time to do it, given all the pain that industry seems to be going through? That's where I wanted to start.
I think the answer that has to be an unequivocal yes. So if you just come back to 20 to 23% rate of tax, what you're talking about is 33% stated rate of tax. And you have a 21% which is your MAT tax. And you are somewhere in between that, because if you have book profits, there is no way you are going to go below MAT tax by and large. Okay. With that situation, I think if you look at corporate India, first of all, most of the exemptions are dwindling down. There are very few of them remaining. Those which are remaining, if there is a sunset and they are eliminated, corporate India would rather not want to have litigation. And I can give you n number of examples. I won't sort of take a lot of time on that, but effectively every corporate will come back and tell you that every time they claim a deduction or an exemption, there is paramount litigation with tax office being on the other extreme, as if there is sort of a evasion happening. Okay. It's a stated deduction, then there are issues. So for example, you have SEZ, have you maintained separate books of accounts, is it a reconstruction? On one item you have virtually 80-90 items why tax benefit could be denied to you. Okay. And on the other hand, tax office comes back and says that corporate India is shifting profits only to those undertakings where profits are. So the answer is somewhere in between. And I would rather that those go away and you have a certainty on rate of tax.
Okay, so optically, they don't mind going from the current effective tax rate of about 23% to, let's say, 25%, if it means that all the other pain of being able to get these, deductions and exemptions goes away.
But that said, I would only sort of venture to say that I don't see 30 to 25 happening in one year.
No, over 3 to 4 years.
Absolutely.
That's what the finance minister has also stated.
I would absolutely agree that corporate India would very much welcome it.
So I'm assuming even the deductions and eliminations will go away over 3 to 4 years. It's not all...
I'm not seeing that. I'm seeing a mismatch to say that deductions will go away. They will remain only as a part of sunset. We have a couple of issues to talk about, R&D, etc., and we'll leave that aside for a moment. But what I'm seeing really is exemptions and deductions coming to a sunset and the rates going down gradually.
Okay. It's not as simple as 33 and 23. Because when we talk of 23-24%, that's an average of the entire corporate tax basket. You'll find within that basket some corporates, some sectors which are really benefiting from these incentives, from these benefits and exemptions, who are paying much less than 23. And others who are probably paying closer to 33. And therefore, there will be some sectors, some segments, some corporate houses and some companies which will lose significantly if the rate comes to 25. And it won't just be from 23 to 25, which is an average of the basket.
Which ones will those be? For instance,
and
infrastructure?
Those could be infrastructure, those could be pharma, those could be
so these are all who are possibly below 23. And
Absolutely.
I know that many pharma companies, I think, are between 20 to 21 right now.
Absolutely.
And they will feel the pinch if they go to 25.
Absolutely. Right? And probably, you'll find exporters, SEZs, you'll find pharma companies, infrastructure, who will lose much more. So there will be definitely vested interests in various sectors. Getting a consensus is going to be tough, and therefore, whatever the finance minister does, he'll have to be decisive.
So you're expecting to see a roadmap in this budget?
I would think so.
A very clear roadmap. Mr. Desai, what should that roadmap look like according to you?
I think even if he gives couple of percentage, concession to the tax rate, concession not in the sense of exemption.
So he should front load the reduction?
At least he will set a direction, and it will give a kind of a positive signal that now things are going to happen.
Just one second, before you
And
continue to
that's-
that. So do both of you agree that he ought to front load the deduction in tax rates? So take the bigger knock in the first year so that companies feel more confident about the roadmap, or does he have the fiscal space to do that?
No, he would, because a 1 to 1.5% reduction will be more than compensated as he takes away many
But
of the
he needs to
deductions.
go from 34% to 25%. So 1 to 1.5% doesn't do much, right?
So again, when we are speaking about 25 and 33, we are not comparing apples and like to like.
Are you
Because
saying it's going to be 25 plus all the cesses?
he has never said it won't be. So we are looking
So he's
at...
going from 33 to 28.
So if you just go back to his speech, and I read very carefully, it says, I'm reducing the rate from 30 to 25. He has never said I'm reducing from 33 to 25.
So basically we're talking about an effective tax rate of 28 with all the cesses,
27 and a
etc.
half or whatever, depending on whether surcharges
So
continue
you're
or
expecting
not.
only a 1.5% cut in the first year?
I'm expecting 30 to be cut by 1 to 1.5%, and that is
In
not
the
what
first year.
in the first year.
I would feel the phase out will start only after March 17. And if the phase out starts only after March 17, I think the reduction in the rate also will start only after March 17.
So nothing for the
In all
next
fairness,
fiscal?
I would feel so. Second, I would feel that the overall corporate tax rate, including surcharge and cess, should be brought down to 25, not exclusive of surcharge and cess.
It's not a great idea to just postpone to 2017. We should start showing some signal, because government must take one small step.
But does he have the fiscal space to do
the
that? We
thing
just
is-
discussed that earlier on.
No.
Can he give away a big tax rate cut right now
I say
when the deductions and exemptions might only fall off 3 or 4 years down the
It's a
line?
small tax cut on the rate. I didn't say big tax cut
Okay.
in this year. It is
Okay.
a 1% reduction also will send a strong signal that now this is happening.
Okay, but tell me, do you expect that all the exemptions and deductions will go away? Because everybody I speak to in industry, the guys who benefit from the R&D, auto, pharma, they say, oh, no, do away with all the exemptions
Except
and
mine.
deductions, except mine, because mine is very important. We need to build IP in the country. You talk to infrastructure says, do away with all of them except ours, because the country desperately needs infrastructure. You talk to SEZs, they'll say, oh gosh, look at export performance over the last several months. How can you do this to us? You've got to keep us competitive. Do away with everybody else's exemptions
Not
and deductions,
lawyers, we never
but not
ask
ours.
for one.
I know. So I'm just curious to know, what will that roadmap have in terms of the elimination of deductions and
I
exemptions?
think by and large, number of exemptions that we have been seeing, I think can easily go away.
Including the R&D one?
R&D also should go. If you want to give direct subsidy, which again is a controversial subject, because France has given $430 billion subsidy. OECD is engaging in harmful, I would not say harmful, but tax competition, right? UK announced 10% tax on patent box, Netherlands 5%, Italy 10%, France have. Now, so when you're competing on a global basis, maybe you'll have to take a judgmental call.
So you're
and
saying
then-
convert the weighted deduction into a direct subsidy?
No, I'm not suggesting for a moment.
Okay.
I'm saying you consider all the circumstances that you are surrounded by, and take a view that is most suitable to our country.
First of all, there are two types of exemptions which have happened thus far. One is expenditure-based exemption, other is profit-based exemption. A profit-based exemption is disproportionate to the investment. So you could invest 100 and you could make a profit of 10,000 and claim an exemption on it. That is what the DTC said, that we should do away and move to a regime of only investment-based exemption.
Right.
An investment-based exemption has two types of elements again. One is a pure deferment, but which provides a cash flow to the industry. Other is a plain exemption.
Let me turn my question around this way, Mr. Kanabar. I'm going to run through the list of the most expensive incentives, tax incentives in the country right now, and you tell me which ones you think are going to stay or go. So the total revenue lost because of tax incentives is in the region of 62,000 crore rupees. This is after you net the MAT income, okay? Accelerated depreciation is 37,000 crore rupees.
That ought to
Deduction
go
of-
because it was only meant for development of a particular
So ought to
region.
go.
That has
Okay. SEZs, about export profits of units located in SEZs, about 18,000 crore rupees. That ought to go as well. Sunset clause.
Absolutely.
All
It's
done.
already there. Yeah.
Okay. Then power. Generation, transmission and distribution of power, about 10,000 crore rupees. Ought to go or stay?
It could continue as an investment base as opposed to profit base, which will get it down from 10,000 crores to maybe 2,000 crores, but will still promote investment in that sector.
Okay, scientific research, expenditure on scientific research.
That's the only one I would think.
8,000 crores.
That's the only one which I think ought to stay.
Ought to stay. Okay. Profits of industrial undertakings derived from mineral oil and natural gas,
None of
6,000
those.
crores.
None of those.
None of those. Development of infrastructure facilities, 3,400 crores.
I said none of those other than scientific research, which makes India extremely competitive.
Sikkim, Uttaranchal, Himachal, between the
All
three
has
of them, yeah, all should go.
Absolutely.
Okay. All should go except for scientific research.
I would feel if the tax rate overall, including surcharge and cess, is coming to 25, all can go.
All can go.
All can go.
Including R&D.
Including R&D.
All can go, including R&D?
By and large, yes. Except the SEZ, not SEZ as we understand normally, but I would talk, for example, Finance Minister talked about international financial city, gift city, for example. It will need 25 years exemption. Because the idea is to get the activity which doesn't exist. And Finance Minister's statement, if you go by that, he said, we want to compete with Dubai and Singapore. You don't make a statement, then I'm fine. He has made a statement.
Okay.
Now, Dubai gives 50 years tax exemption, and Singapore, there is no capital gains, there are other benefits. So if you want to become like that, and if you want to compete with them, then you will need to give that exemption.
I'm also going to bring up the fact that the government is pushing very hard on the startups front and has spoken of incentives for startups. Now, on the one hand, we're talking about doing away with all exemptions and deductions and hence tax incentives. But on the other hand, we're still saying, hey, look, maybe we need to encourage startups by giving them some sort of tax incentives. Are you expecting to see anything in this budget when it comes to tax incentives for startups?
I do. Although I would think it goes counter to the very policy that we are talking about of phasing out incentives. But given the way the announcements have been made, I do expect something on startups.
Specifics like?
So in terms of investors and the benefits to an investor if he exits in a certain period and reinvests back into other startups, in short, a rollover exemption for capital gains.
So those are some of the things that they've already put out in that one-pager, right?
Yes, and I do feel that some of those will come.
Will we hear on MAT as well along in this roadmap when that comes up? Because if we don't, then that becomes again counterproductive to the entire philosophy of simplifying things, right?
It has to.
It has to.
So first of all, you cannot have a situation. So at one level, if you do away with exemptions and deductions, one argument is that MAT ought not to be there at all, because then there is no question of taking anything. Assuming that some of the exemptions will continue and assuming that MAT therefore continues, MAT cannot be at 20% if my headline rate of tax is 25%.
So what should he signal MAT coming down to in this budget?
MAT cannot exceed more than 50% of the head rate of tax. Can never be.
But I would feel that once all the exemptions and deductions go, MAT becomes redundant anyways.
And I'll come back to the one that you said, the one exemption that all of us benefit from, not just industry, the long-term capital gains exemption. Now, there has been a rumor in the marketplace the last few weeks is that under review? Will that go away? Equity investors are most worried about that. What do you expect that this is going to go away?
So there's a lot of speculation, rumor mongering going around, and without giving credence to that, I think this has arisen from Prime Minister's statement that almost about 62,000 crores of taxes are not paid because of the exemption on capital gains tax. I don't know where that number comes from, and that has sort of given sort of fear psychosis to say that will this be taken away. And I've heard multiple rumors. Two of the rumors which come up, one is to say that the 1 year holding period for long-term capital gains for listed will go to 3 years. Other is to go back and say, will there be a 5% rate of tax, etc. And I really don't want to speculate on what will happen or not happen. But I think the current regime has been around very stable. I don't think it needs to be disturbed at all. It is disturbing that could be counterproductive to the government's disinvestment plan. But one thing which I can look back and say again on DTC, that at some stage DTC had proposed a 5% long-term capital gains. And then it did something to avoid a sell-off and it said that the cost base will move to 31st March of that year. So if, for example, the government came back and said that we're going to have a 5% long-term capital gains tax, but the cost base will be taken to be 31st March 2016, then maybe there is a price which is being paid there, but there's a step up of the cost. So
effectively your tax payout is very, very little.
Correct. Only on the increment beyond 1st April.
Yeah.
So what will the government do? I don't know. I can't speculate. But I think the government will not do anything which will disturb the capital markets. It turns counterproductive to the disinvestment plan.
Okay.
I think our tax, capital gains tax regime is so complicated. It's so difficult to explain to a foreign investor or even to an Indian investor that it makes mockery of the whole system at times.
Mr. Desai, since we have you here, I should ask you.
I know
Because you are counsel for the Mauritius government,
I'm
so
sorry,
I should
not have
ask
spoken anything.
should we expect anything regarding the treaty in this budget? Is he, not that the budget is the vehicle for that, but could he likely make any kind of announcement there?
I don't think so.
You don't think so?
No.
Okay, fine. Since we are running very short of time and there are maybe other changes we also do want to bring to the notice of our viewers. Pranav, Mr. Kanabar mentioned BEPS. The expectation is that the disclosure formats for country-by-country reporting will be introduced in this budget. Right. No immediate material impact, but yes, all the material impact that BEPS brings onto the table will be felt in some way through CBCs, so to speak. There are issues around POEM that people are expecting will get addressed in this budget. So besides the exemptions, deductions issue, can you very quickly in a list tell me what are the other things that you're hoping will get done?
So I am expecting something on BEPS, though I think it will be more in the nature of announcements. I'm not too sure a legislative change might be required to that extent, especially if it is surrounding CBCR, which is country-by-country reporting. So my sense is certainly there will be some form of documentation, but that could come through the rules, etc. On the POEM side, I would strongly feel that a deferral by at least 1 year is absolutely necessary. Given that the POEM guidelines are not yet out, we are already almost close to the end of the year, the taxpayer has no clue what the POEM guidelines will say. So my feel is that a 1 year deferral is certainly called for and should come given the way this government thinks. It doesn't like to do things retroactively. I would feel that ICDS is another thing that is likely to probably get deferred.
The Ishwar Committee has recommended that
Ishwar Committee has very much recommended that. So I would feel most of the recommendations of the Ishwar Committee should find their way into the budget.
Any material ones that viewers should be prepared for?
Yes. So for example, the one on Section 14A, that the dividend exemption does not mean that the expenses in relation to the dividend income is not allowable. For the simple reason that dividend is exempt in the hands of the shareholder, but the company does pay a DDT.
That actually translates into a relief for companies.
Absolutely, and I think that's a very, very fair step to bring through, and that shows the fairness of the tax regime. So I think that should come through. For example, also characterization between business income and capital gain will come through. I think some of the steps concerning withholding tax will come through, which will be a good relief.
I think POEM not only must be deferred, actually it should be not introduced, because our law in 1922 Act of Income Tax was an improvement over POEM. POEM was 200-year-old concept.
So you're saying POEM should be eliminated, not just deferred?
It has created so much subjectivity, that's one thing. Of course, I expect that hopefully the 10% withholding tax on the AIF, that should really go, because, you know, people, why should they invest through the fund? You know, they will make direct investment.
All right, gentlemen, on that note, I'm going to have to wrap it up here. Thank you very much for joining me. This is the first of our 3-part series ahead of the budget. Next week, we'll be back with the focus on indirect taxes. Stay tuned.